G'day there. Welcome to the Closing Bell on the 9th of July. Today, I'm just going to quickly overview sort of the macro situation, have a look at US dollar, euro. We know that, oil's been hammered. There's a few big things afoot. We're in the middle of a pretty amazing time for the markets. My view is that we could be on the verge of a bit of a short squeeze, markets going up, rallying the equities, but it's within the bigger context of a larger downtrend. So any short-term trading from the long side is to be nimble, and you run away pretty quickly if the music stops and the market turns down. So I want to give you a quick overview of what's been going on, and then we'll have a look at the healthcare space. I just think there's a bit of buying coming into that space from currently oversold levels. Overall, that sector really holding up quite well in the recent sell-off, giving you a hint that people aren't willing to sell, and that when things do turn back up, it'll probably outperform. And there's a couple of stocks looking interesting. I'll just give you a bit of a look at a few of those. So let's kick off by looking at the US dollar. And if you've been watching these updates for a while, you'll know I've been bullish on this US dollar. The fact that it will probably break out above that high around 104 and continue rallying, which will be a really important theme for the markets. The way I'm looking at this is similar to what we saw back in 1996 to 2000, where we had a big rally. Then we had years of creating what I call that widening distribution, where it's really going nowhere, but trying to break out. So there's years of trading. And then finally, the breakout above the high of the range leads to quite a sharp move to the upside. And it's a very similar situation now, where we've had this initial rally, we've had the range, the correction, then we've had those false breaks that I keep talking about, either edge, sucking everyone into bad positions, bit of an internal range here. We've got 5 years of trading between 92 and 104, and we are now, breaking out to the upside. So that US dollar could have a lot further to run. You've got a few things going on. European growth coming off very rapidly. Are they going to raise rates very much? They're dragging their feet at the moment. So the euro getting belted, going back towards parity. So US dollar flying. You've got the US 10 years, up around 3% yield. If you're an international investor and you're seeing the whole world crumble around your ears, you're looking at those US 10-year bonds with a 3% yield, and you're thinking, well, that's not looking so bad right now, even if inflation's 5%. And inflation's probably going to come back off. If I'm looking from a 10-year point of view, maybe that's actually not a bad yield for now. So this is what's going on. Big capital flows. I mean, when you're looking at the currencies, you're thinking about the big capital flows. Where are the really big boys and girls putting their cash to work? And are they shifting between, Europe and the US? Japan, what's Japan doing? They've got heaps of surplus money out invested around the world. When they move money around, it has huge effects on the market. So that's where you get your big hints. Now, the US dollar flying, we know, will affect commodities, won't it? We've seen oil coming off pretty hard on the back of, very weak growth figures starting to come out of Europe. Will demand come off? Remember back in 2007, 2008, as things were crashing, oil rallying up to $150 and then turning and crashing in a straight line back to somewhere around 30 or $40. This is a sort of thing that can happen when things break. And also copper's come off pretty hard as well. Look, there's a lot out there to be considering. But through all of that, I'm considering whether we're on the verge of a bit of a short squeeze. And this is one moment when I could have a lot of egg on the face within a week or two. If some bad news comes out of the woodwork somewhere, things can turn down and look terrible. So I just want to start off by saying that. So if we're thinking about that US dollar, saying it's a major breakout, and, I guess the caveat would be if that US dollar turns down rapidly and has a false break of that 104 level, then you're saying, right, it's still stuck in that long-term range with a midpoint, that point of control around 96, let's say. And really, we've just seen years and years of oscillating around that level. So we'll know if the US dollar does get hammered back below, 103, 102 in the short term. It's saying, be careful, the US dollar may actually be about to sell off back to that 96 level. But as long as this thing holds above that sort of 102 to 104 region, we've got to allow it to actually surprise on the upside from here. And what does that mean? What does it mean for gold? Gold coming under a lot of pressure. I've been saying to you recently, I've sold out of most of our gold stocks a month ago, and I was getting very mixed signals on gold. So I was a bit wary, and now it's starting to sell off, and I'm wary that it could sell off a lot further. So that's one area where I'd be a little bit wary on the back of this thought that US dollar may really surprise to the upside from here. Also, oil prices, look, it really does hinge on growth. If growth is going to come off, we have to think about what oil could do. This is the very long-term chart of oil going back many years, back to 1990. What I'm looking at is this major wave in oil up into that 2008 period. This is what I was talking about before, where oil turned and crashed. Now, if we're looking at it in relation to that initial large wave to the upside, remember, I'm looking at the buy zone of that area. I'm looking at the sell zone of that area. And you can see that most of the trading since has been respecting that, where we have moves to the buy zone, back to the point of control, up to the sell zone, point of control, sell zone, point of control. Lots of work done. Big sell-off back to the buy zone, back to the point of control. Big sell-off again, and this is when it went crazy, down to zero, the futures market, that is. And, back to the point of control. So here we are, back up in that sell zone again. You can see that the high of this rally has been right at the top of that sell zone. And so it's really up in an area of massive resistance for oil prices. So I'm not surprised at all to see things backing off. But the uptrend is still very strong. So we've got the 10-month exponential, you can see there. Prices actually bounced off that recently. So, you really need to see oil breaking down below. There's the highest price candle on the monthly. The low of that price is $93.50. That's on WTI crude oil. So, if we see oil prices crashing down below $93, which would also be below that 10-month exponential moving average, then I could start, thinking about oil heading back to the point of control, which is around $80, and would also match up with that 20-month simple moving average, which is the real fulcrum for prices. But that doesn't mean oil prices won't then turn up and, threaten the upside again, because the long-term moving average, the long-term trend is still up in oil. Just because you have a correction doesn't mean it's all over for oil at all. But it's just that the risk is to the downside when you have, massive resistance in this area, multi-decade level of resistance that's failed many times in the past, and you have growth certainly coming off the boil quite rapidly, and a determination from the Fed to keep raising rates until something breaks, to try to snuff out inflation, perhaps oil is going to struggle a bit. So I'd say the line in the sand for me, under $93, be a bit wary of what oil prices could do. But as long as they hold above there, who knows? It's still a very strong uptrend. Moving on to just the equities. And the first thing I want to point out in the S&P 500, we're looking at a long-term chart here. It's a logarithmic chart. What does that mean? That's just saying that we're looking at percentage moves being equated across the chart. So that means, 100% move up here is going to be the same distance as 100% move down here. Whereas when you're looking at a normal chart, it can all go a bit weird, because when it's at very low prices, going from $10 to $20 is 100% move. But going from $100 to $110, which is still a $10 move, is really only a 10% move. So it can just make charts look a bit weird over very long term pictures, and it doesn't give you a very true knowledge of the moves. So by looking at this log chart, I'm looking at the big sell-offs that we've seen in the past, 2001 to 2003, 2008. So now they're equated as far as percentage moves over this chart. So I've just overlaid those moves from the all-time high to give you a sense of what happened, in 2000 and what happened in 2007, and have a look at where we are right now. So looking at that, here is the sell-off we've had so far. So the sell-off we've had so far, has gone to here, around 3,800. And this is what happened in 2008, a move that far. So that would be down to 2,000 in the S&P 500. And this is what happened from 2001 to 2003, a much slower sell-off, but it sold off from a percentage point of view to a pretty similar level to the 2008 crash. So that would take it down to 2,300. So that would be if we see quite a serious sell-off. That's just to give you a sense of what can happen and where we might be in this sell-off currently. So that's one thing to consider in the back of your mind, is that the sell-off we've seen so far is still pretty early days if we are going to see something similar to what we saw 2 decades ago. But having said that, if we just look at the very short term, and I just look at the weekly for you, I've been looking at this as, potentially shaping up for a short squeeze, and it is starting to sort of take shape, but still very early days. When it's trending down, the sell pivots. So when we get the sell pivot, like we saw there, which I told you about at the time, they're going to have a higher probability of being successful. So in a downtrend, the sell pivots are going to have a higher probability of being right, whereas the buy pivots are less likely to be right. So you can see there, we had a buy pivot on the weekly. Yes, we did get a bit of a rally, but it went up into the selling pressure and then sold off again. And quite a while ago, we got another weekly buy pivot here, but then the selling pressure came in, and look, that's when we saw the really big sell-off. So that weekly buy pivot didn't work, this one here. So that one didn't end up turning into a bigger rally. But now that we've had another big sell-off and we've got this weekly buy pivot a couple of weeks ago, I'm looking at that and saying, will this potentially turn into the start of a bit of a short squeeze? Because everyone's on the same side of the boat. We've had a really big sell-off. Yields are falling rapidly because growth is coming off rapidly, taking the pressure off a little bit. So there is just a chance of a bit of a balancing up period. So what I'm seeing here is that we've got the weekly buy pivot back towards that midpoint, the buy zone of that area, that's where you want to see the buying pressure come in. We are seeing that. So if we can see a bit of a breakout here to the upside, you should see a bit of a squeeze to the upside, even to the 20-week moving average. And look, it could end up going higher. If I'm analysing this quickly for you, I'm looking at that sell-off and I'm saying, well, if we do rally, it can go to the midpoint or it could even go to the sell zone. And that's the area where you're saying, right, that's where I'm taking profits, getting out of stocks that I was scared of losing heaps of money during the recent sell-off. Because if the selling pressure is there, that can be the beginning of a really bad wave to the downside. So yeah, I'm not calling the low of the crash, just that there's a chance with a bit more upside, we could see things igniting. And remember, tax loss selling is done. A lot of stocks out there have been selling off for 2 years. I think there's going to be a bit of a bounce back in a few of those. So that's how I see things right now, is that we're on the cusp of potentially a bear market rally, which could be traded. But the fact is, I am out and fully bearish as soon as the market turns down and breaks below the low of the correction. So, it doesn't have to go that far to have me turning off completely and going fully bearish, because below the low of the correction, that's where I don't know what's going to happen. It could get pretty unruly under there if the market turns down quickly below there. But, that's what creates the opportunity, because you don't have to risk too much to find out if you're wrong. And if you're right, there's potentially quite a lot of upside. So your risk reward currently is to be buying, I think. So finishing off with the healthcare sector, where I've seen a bit of buying coming in. This is the monthly of the healthcare sector. Obviously, this one is lopsided towards companies like CSL, which is just so huge. Their moves end up really taking over the index, and you end up with a chart that's similar to CSL when you're looking at a chart of the index. But I am seeing some stocks out there really see some good buying. So this is ResMed. It's been trending up beautifully for a long time. This is a very nicely trending stock. They had a really big rally when one of their competitors got knocked out. So they've rallied up to around $40. They've pulled back nicely, towards the buy zone of the most recent wave. If I'm looking at that, you can see there, pulled back right to the buy zone of that wave. We've got a monthly buy pivot last month, and it's starting to take off, starting to trend again. So if the market is going to rally, that sort of stock, which has really good fundamentals in a space, with COVID ending, the healthcare space has had trouble during COVID, getting into hospitals, talking to people, that sort of thing. So we're getting a big recovery in a lot of that health space as COVID rolls off a bit as a big worry. And, it's a defensive sector, right? When everything's going pear-shaped, it's looking at those defensive sectors is what you want to do. So, I think stocks like that, also in the higher risk space, I'm seeing some buying coming in. Polynovo, for example, I think I spoke about them months ago when they were down around $1. And with this one, we've had a huge sell-off. Again, if I just look at the most recent wave to the upside, you can see prices pulling back into the buy zone there. We've got the monthly buy pivot actually a couple of months ago. And also I'm looking at the false break of that old low from 2020. So a lot of things saying that this thing wants to head towards that point of control, up around $2. But, maybe some volatility along the way. But just a few of these charts stacking up basically in that healthcare space. And I won't tell you about the others because I'm thinking about buying them. So that's enough for this week. Rabbited on for a while. Hopefully it gives you a sense, possibly having a rally, but it's a bear market rally. Be nimble, don't be cheeky, and run away pretty quickly if things turn down again. All right, cheers. Check out what I'm up to. Check out Pivot Trader. Check out Microcaps. Come and trade with me. And otherwise, I'll come back and chat to you next week. Cheers.